A while back, I was talking with an adult daughter whose mom had gotten a reverse mortgage a few years earlier. Her mom had recently passed away. In the middle of our conversation, she stopped and asked me, Dale, what happens now? Does the bank automatically get the house? She wasn't asking because she wanted to keep the home. She was asking because she genuinely had no idea what came next. And honestly, she's not alone. I've heard questions like that over and over again. The bank takes the house, the kids inherit the debt, and there's nothing left for the family. Those are some of the biggest myths surrounding reverse mortgages. The good news? That's generally not how reverse mortgages work. Today, I want to walk you through what actually happens after a homeowner passes away so you can replace fear and misinformation with facts. Hi, I'm Dale Corpus. I'm a Senior Transition Strategist, Realtor, and reverse mortgage specialist based in the San Francisco Bay Area. I help families figure out how to pay for senior care, especially when a home is involved, whether they're considering aging in place, assisted living, memory care, or using home equity strategically. My role is to help families understand all of their options so they can make informed decisions and avoid costly mistakes. This is another episode of Sandwich Generation Solutions powered by the Simplify Senior Transitions podcast, where we bring clarity to the housing, care, and financial decisions families often face during some of life's most challenging transitions. Let's dive in.
Welcome to the Simplify Senior Transitions podcast, where we help families navigate senior living, real estate, and everything in between. Hosted by Senior Transition Specialist Dale Corpus, this show brings you expert insights, real solutions, and stress-free strategies to make senior transitions simple. Ready to dive in? Let's go.
Let's start with step one. A reverse mortgage doesn't mean the bank owns the home. Let's start with the biggest misconception. Many people believe that once someone gets a reverse mortgage, the bank somehow owns the house. That's simply not true. The homeowner continues to own the home. Their name remains on the title. A reverse mortgage is a loan that's secured by the home. It isn't a transfer of ownership. So when someone passes away, the home becomes part of their estate, just like it would a traditional mortgage. That's an important distinction because it changes how families think about what happens next. Step two, the loan eventually becomes due. So what actually happens when the last borrower permanently leaves the home, whether because they pass away or move into long-term care? The reverse mortgage eventually becomes due. That surprises some families because they assume the loan just continues indefinitely. It doesn't. At that point, the loan servicer contacts the estate or the heirs to begin the process of settling the loan. The important thing to remember is this: don't panic. There is a process and families typically have time to evaluate their options. Step three, the family usually has options. This is another area where misinformation creates unnecessary fear. Many people assume there's only one outcome. There isn't. Depending on the family's circumstances, they may decide to sell the home and use the proceeds to pay off the reverse mortgage, keep the home by refinancing the reverse mortgage into a traditional loan if they qualify, or if keeping the property doesn't make financial sense, they may decide not to retain the home. Every family situation is different. The important thing is knowing there are choices. Step four, what happens if there's equity left? Let's use a simple example. Suppose mom's home is worth $1 million. Let's also say the reverse mortgage balance is $400,000. If the home is sold, the reverse mortgage is paid off. The remaining equity belongs to the estate, not the lender, not the government, the family. This is one of the biggest myths I hear. People assume that once there's a reverse mortgage, there's nothing left for the children. That's simply not true. If there's equity remaining after the loan is paid off, it belongs to the estate. Step five, what if the loan balance is more than the home is worth? Now let's look at the opposite scenario. Suppose the reverse mortgage balance has grown larger than the home's value. Families often worry they'll have to come up with the difference out of pocket. Fortunately, many FHA-insured reverse mortgages include something called non-recourse protection. What does that mean? In simple terms, neither the estate nor the heirs are personally responsible for paying more than the home's value when the loan is settled. That's one of the strongest consumer protections built into these loans, and one that many families have never heard about. Step 6, the biggest mistakes families make. In my experience, most of the problems families encounter don't come from the reverse mortgage itself. They come from misinformation. Families wait too long to contact the loan servicer. They assume they have no options, or they make decisions based on something they heard years ago from a friend, a neighbor, or something they saw online. When you're already grieving the loss of a loved one, the last thing you need is confusion about the next steps. Having the right information and the right professionals to guide you can make the process much less stressful. One thing I tell families all the time is this: don't let myths make your decisions. Let facts make your decisions. Reverse mortgages aren't the right solution for everyone, but they're also not nearly as scary as many people have been led to believe. The more you understand how they actually work, the more confident you'll be when deciding whether one makes sense for your family. So, what happens to a reverse mortgage when someone passes away? The bank doesn't automatically get the house. The heirs still have options. If there's equity left after the loan is paid off, it belongs to the estate. And if the loan balance is greater than the home's value, many FHA-insured reverse mortgages include protections that help ensure their heirs aren't personally responsible for the difference. Like so many decisions involving senior care and housing, the best decisions come from understanding the facts instead of relying on fear. And before we wrap up, I do want to mention something important. Every reverse mortgage program is different, and individual eligibility, loan terms, and circumstances matter. The timelines, procedures, and options available after a borrower passes away can vary depending on the loan program and the family's specific situation. This episode is intended for educational purposes only and shouldn't be considered legal, tax, or financial advice. If you or your family are facing a reverse mortgage decision, consult qualified professionals, including tax, legal, and financial advisors who can evaluate your specific circumstances. This has been another episode of Sandwich Generation Solutions, powered by the Simplify Senior Transitions podcast. If you are trying to figure out how to pay for senior care, especially when home is involved, I've created resources to help families better understand their options before making important decisions. You can obtain personalized guidance and educational resources by going to my AI Resource Explorer at simplifyseniortransitions.com/start here. And also check out my podcast library, explore conversations with senior living experts, elder law attorneys, home care leaders, financial professionals, and families navigating these decisions every day by going to simplifyseniortransitions.com/podcast library. If this episode helped clear up some of the biggest myths surrounding reverse mortgages, I'd really appreciate it if you'd subscribe, leave a 5-star review on Apple Podcasts or Spotify, and share it with someone who's helping an aging parent plan for the future. I'm Corpus. Thanks for watching, and I'll see you on the next episode of Sandwich Generation Solutions.